Personal finance practice problem using OneNote. Fees, long-term costs. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side of the Practice Problems tab, down in the 4110 Fees, Long-Term Costs tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking at fees and the impact of what small fees might have over time, considering in particular fees with relation to financial institution. Small fees such as fees for the ATM use, possibly ATMs that aren't the ATM of the institution. You can have a similar concept for fees such as minimum balance fees into a checking or savings accounts that you are paying, and how those might add up over time, helping you possibly to make comparisons between one institution and another institution. So we're going to imagine here, and we will be using time value of money calculations to analyze this. And if you want to look at time value of money calculations more in depth, take a look at a prior section where we focus in on that. We'll use those tools here. Also note, as we consider this, we kind of have the objective, as we've stated, of seeing that these fees can have an impact in the future. And you might want to start to think about how you would use these terms if you wanted to emphasize, in this case, the impact of small fees over time, as we'll see here. And then also how that could be kind of distorting. In other words, you might want to think about how people might use these value of money terms in order to emphasize what they're looking at. We'll talk about that in a little bit more detail as well. So our objective here is to try to figure out that small fees could have an impact over time. So we're going to say that we have the ATM fee per transaction. So we're going to assume if we don't use the ATM that is at the institution, it costs us $3 per transaction. And if we are to do that often, possibly because we don't have an ATM related to that institution around us, and we pay it constantly $3, and let's say we do it 100 times in a year, then we can figure out how much that would cost us per year, $300, and then we can figure out how much it might cost us over a longer period of time, a number of years, which we're going to choose 9 as the number of years, and then we'll figure out what might be the future value calculation. And then we'll also look at a present value calculation as well. So let's first calculate this out over 9 years. How much would that just straight cost us, not taking into consideration time value of money? We say the ATM fee, $3 every time we do this. And we're going to say we used it 100 times a year. We go to this ATM and we pay the $3 just to get some money. And that adds up to, of course, $300 a year. So it's going to be $300 a year. If we say we do that for 9 years, fairly long time, the 300 times 9 years would mean we have the $2,700 over the 9-year period. Now, you might also then say, okay, well, what if I take into consideration time value of money? And I say, well, what if I save that $3 over the $300 a year in essence, and I put that money into a savings account and was able to earn on it 7%, what would be the future value that I would have after the 9 years if I was to save it in that way? We could do our future value calculation. This is going to be in Excel. Like I say, I'll do it fairly quickly because we focused in on these in the past. If you want to focus in on the tools, how to calculate future value and so on, you can look at the section in more detail to do that. But in essence, we're going to say negative future value. This is the Excel function format way of doing it, as opposed to a mathematical formula, which you can look at, or tables in the prior section. So we'll pick up the rate. The rate here in our little dialog box is going to be that 7%. We're going to assume that's an annual rate that we'll be taking a look at, comma, number of periods. The number of periods we're going to say is 9 years. We're going to compound this thing on a yearly basis. And then, comma, we're going to then take the payment amount. The payment amount we're going to assume is going to be the $100 times the 3 years, or $300 a year. That's why we have this little multiplication, 100 times 3, or 300, giving us the future value of the $3,593. The $3,593 is the future value we may have if we were able to basically take that $3 every transaction, which adds up to 300 a year over the 9-year period. We can then verify that by doing our running balance calculation, which we'll do fairly quickly here. You can do this quite easily in Excel, giving us a better example or idea of this future value of money. We got the time periods 1 through 9. That's going to be the number of years. We then have the amount of the payment, which we're going to assume in normal annuity fashion happens at the end of the year, therefore no increase in the current year. Then we have the $300. If we were to invest that and we were going to earn 7% on it, we would take the 300 times 0.07, and we would be getting, hold on a second, 300 times 0.07, we'd get the 21, that plus the 300 that we started with, plus another 300 that would be for the second year, would give us to the 621. We would then calculate the 621 would be our new balance times the 7% earnings. For year 3, we would be earning, hold on a sec, something funny happened again, 621 times 0.07, that gives us about 43, plus the 300 that we would be putting in year 3, plus we'd have the 621, and that would give us the 964. Let's do it one more time. If we had the 964 times 0.07, we have about 67 or 68, taking that plus the 300 for year 4, plus the prior balance at the end of year 3, 964, that gives us the 1332, and so on and so forth. And that gives us an idea of how, if we took that $300 a year and increased it with an investment at the 7%, we'd have an increase in the funds as the balance goes up, compounding it on a yearly basis, getting us to that $3,593, same item that we had up top here. Now, you might be saying, hey, look, that's not exactly fair, because notice what I'm trying to emphasize here is I'm trying to emphasize the fact that we would have this future value. But really, you're saying, well, that's the future value. You might say, well, look, if I pay $300, a year, then, and you're saying that's an annuity, we should be taking that series of payments and possibly discounting it back to the current time period, meaning I'm paying $300 a year, but that next 300 is being paid into the future. So it's not really fair, in other words, for me to look at this first calculation and say I'm actually paying over 9 years $2,700, because that last $300 was paid 9 years into the future. So really, if I instead of bringing this into the future and telling me what the future value is, or even keeping it as $2,700 and not considering time value of money, you could argue the most fair thing to do is bring it back to the current time period, into the present. You should be present valuing that $2,700 to see what that series of payment would be in terms of present value dollars. So in other words, if I discount it back, that series of payments, to using a 7% discount rate on it, then, and note, when you think about this 7%, you might ask of where the 7% would be, and that could include inflation. We talked about this in the time value of money section, but it could include inflation, and it could include what else you could do with the money, the other thing that you can do, which could be like, say the investment of it or the use of the money. So we got the 7%, and that would be the present value calculation, negative PV. The rate here is going to be that 7%, comma, number of periods we're going to say is going to be 9, and then comma, and then the payment now is going to be the 300 again, which were calculated as the 100 times 3, and that's going to give us the 1,955. So in other words, the dollar amount would be the 2,700, but if I bring that series of payments that we're talking about to the present, we're talking about 1,955 if we discount it back using the 7%, which you can also see if I took the same annuity calculation we calculated here, we got to a future value of the 3,593. That's how much we would have after 9 years. But really, that I used an annuity to get up to that number. If I was to say what we had in today's dollars, we would have to discount this number back to the current time period, which is now, at this point in time, to value it as of today instead of valuing it 9 years into the future, which would be the present value of one calculation rather than present value of an annuity, present value of the rate, which would be that 7%, comma, number of periods, 9 again, and then comma, we don't have a payment this time because we're not talking about an annuity, therefore 2 commas, getting us to that future value, which we're picking up that 3,593, bringing that all the way back 9 years to the present, which would give us that 1,955 matching, our present value calculation up here. So just to recap this, note that if we look at this $3, it does have an impact in terms of it does add up, and it's going to be something that we want to emphasize. If I wanted to overemphasize that value and possibly not be exactly fair about my representation of it, right? We would say at the least we could say it adds up to 2,700, over 9 years, right? But even that is overstating it if you're talking about present dollars, possibly. Or you can go even further and say, well, what if I future valued it, and if I invested it instead, I'd have 3,593, which is fair. That makes sense if you were earning the 7% on it. But now you're talking about future value 9 years out that you earned investment on. And you might say, well, if you're talking about that series of payments, then maybe we should be talking about it in terms of present value dollars. And if we use that discount rate to bring it back to not forward period dollars, but into the present and discounted back, we're talking about 1,955 for that series of payments over the 9 years if we're using the 7% as the discount rate. So you could see how you might kind of frame, the discussion or the numbers that you might put together if you're arguing one thing or another, and how, to be fair about it, of course, you'd want to kind of look at both sides and calculate both sides of it and represent the present value and the future value as accurately as possible, so you can look at it from multiple different angles to get a fair representation.